All right, so today's question is what is required rate of return? है ना? थोड़ा सा मुझे इनपुट देंगे, what is required rate of return? What do you understand by required rate of return? So, okay, feasible to do the business. Okay, feasible to do the business. That's an important word. So, opportunity cost. You are comparing between project A versus project B. The project A could be investment in FD versus the project B could be investment in some other. So, investments could there could also be opportunity costs associated with investments, है ना? हाँ, okay. हाँ, so threshold rate, ठीक है. अब बताइए what is the meaning of required rate of return? हाँ, so basic minimum amount that you should earn. What is threshold rate or required rate of return? हाँ, required rate of return. हाँ. Hmm. Hmm. Expected return. So this is expected return. Okay. Uh, Second that you mentioned was opportunity cost. है ना? Opportunity cost. Third point that we have come across is threshold rate. Correct. Let's understand this one by one. है ना? And what are the various ways in which we can understand the required rate of return? There are various ways to understand. What is ROE required rate of return? Is the project return or IRR the threshold rate? So what are the different ways, or can opportunity cost be considered as a required rate of return? Or can WACC, weighted average cost of capital, be considered as the required rate of return? So there are various ways to look at it. So first let's go through it and then we will address all your questions. After we have done recording for the masses, then your specific questions we will take. And then once there are interesting questions, we can make a podcast basis that also. So that also will include, so it is very interesting. So what is required rate of return? First, let's understand from the threshold rate. Okay. So what is the threshold rate? That minimum I need this much. For this project to become feasible, and the other word which is used in projects, if you are working on a metro project, a toll road project, a dam project, an airport project, which is viable or not. So this becomes the minimum rate of return that you will earn. Okay. Now the minimum rate of return is driven by the interest rate in the country. What is interest rate driven by? That we'll understand. So at the base of this, you are looking at all the cues you are taking from RBI, and if you live in the any part of the world, you are taking cues from Federal Reserve, which drives the interest rate. Okay? So Federal Reserve, following the Federal Reserve or following the statements of the governor of Federal Reserve, whoever he is, whether he is politically influenced or not. Important terminology for you to understand whether he is politically influenced or not. And why do I use this? In the classes, we don't talk about politics, but we have written a research paper that if a Federal Reserve, the governor of a federal bank, gets influenced by the politicians, then the damage to the economy is far more. That means the recession, the intensity of the recession will be higher. Okay, so that you will understand. That is something that you will understand and research on. So you will follow the RBI and the Fed governor's statement. RBI, I think, is going. I mean, there is an FOMC meeting or MPC meeting, as they call it, Monetary Policy Committee meeting. Okay, which is happening on, I think, 21st is someone told. So 21st or 22nd. It's a 3-day meeting. Okay, it starts at 10 o'clock, ends at 5. On the last day, just confirm this time, I think this is right. On the last day of the 3-day meeting at 10 o'clock, the governor would come and announce what is their instance on inflation. What is their view on inflation? Not the historical. I am linking it. So listen to the next few pages of your CFA syllabus. I am linking to the next few syllabus. His expectations on inflation. So he's not talking about historical inflation. He will come and talk about what? The expected. He will talk about what? The word here is, the keyword is So your expectations on inflation drives to many things. The governor's expectation on inflation drives many things. The first is the federal rate, or your the repo rate, right? And also the bank rates, the FD rates, the credit card rates, the lending rates, the borrowing rates, the investment rate, and also these. So these actually pick up noise or influence from the inflation in the country, which also impacts the interest rate in the country. So that we will take separately, but you first understand that what is the required rate of return. So the basic ingredient of required rate of return is not the formula. In unfortunately on the professional exams we become very formula driven. You ask them what is required rate of return, they'll start vomiting or spelling out the formula. No, the basic ingredient of the moment you say rate of return, whether it is required, not required, expected, unexpected, historical, forecasted, forward looking, the basic ingredient is what? Inflation of a forward nature. So there are products called interest rate forwards linked to this one. See, we are drilling into the topic. So if you don't understand, so go from required rate of return, understand this meeting, which is on 21st or 22nd, I think it is 21st. Go and listen to his speeches. You'll make a note of it. You'll analyze that. Also go and understand what is expected inflation, right? And also understand what is IRAs or interest rates forwards. Agreements of this is what. So interest rate forwards, please understand. It's all related topic. Now let's come back to our topic. What is required rate of return? So now let me clean up the board a little bit so that I can also speak with ease. What happens to this one? ठीक है. Okay, so the required rate of return समझ गया आप? So the point is expected inflation. That is what you'll follow. Now the threshold return is a minimum rate that you would require based on the interest rate in your prevailing interest rate in your country basis the inflation rate. So the minimum is driven by what? Again, it is driven by what? It is driven by inflation. The moment you say that your minimum is driven by interest rate, you are actually talking about inflation. So inflation is the most important tool which drives your expected return on return. So minimum की आपने बात की, तो you are speaking about inflation. ठीक है? Is it an opportunity cost? Yes, because in the decision tree, if you are accepting or if you are rejecting something, why do you need a required rate of return? Because maybe you have a project A and a project B, right? These are different projects. You want to accept or you want to deny that. So it becomes an opportunity cost in that sense. Okay? These are required, hence expected. You may or may not meet them. Some projects fail because they initially look like they meet the required rate of return, or they would meet the required rate of return, but they are not able to achieve it. So whenever there is a failure to achieve it, when you say this is the required rate of return, you are looking in future. This is not something that you have already achieved. So required rate of return is subject to future volatility or future variations or future expectations or future outcomes. So there is a future which is always built into it. So required rate of return is your opportunity cost also. Whether you should put in this project, whether you should put in that project is driven by the opportunity cost. Now it is also, as I mentioned, because this is in future, this is not the historical rate of return, this is the expected rate of return. Okay. Now a basic quiz for you. Let's have a quiz. So can I clean up all of this? And these inputs came from you. That means you are not at basic level, you are at intermediate to advanced level. If you understand this math, that means your understanding is elevated, it becomes easier to teach. Now the question is, which of these you would call as required rate of return? Okay, here are the answers. I mean the inputs of the MCQs, the multiple choices. One is your threshold rate. Okay. Second is your ROE. Okay. Third is your IRR. Fourth is your WACC, which is weighted average cost of capital. Fifth is your cost of equity. introducing a new term. Maybe you have heard about it, not heard about it, right? Cost of equity. Okay. And maybe, so you have WCC, cost of equity, threshold rate, IRR cost. IRR is the project return. Okay. Or maybe it is some assumed rate. For example, if I want to, my intention for this portion of capital, I have this portion of capital, on this I want to make minimum 15%. So anything which gives me 15%, this could be assumed based on my experiences, based on my capital allocation, based on my risk, sensitivity to the risk. Maybe I have a huge portion of capital. Out of that, no matter what, I want to, this portion I want minimum 15%. Maybe on the next chunk of capital, I just want maybe 12%. I wanted to give it a safer. In this, you have to understand that it's like a, what do you call this? Lever or a swing or a pivot. So you have to understand that risk and return go hand in hand. So they are actually sitting on the same side. If risk goes up, the return also goes up and vice versa. It does not go down. But what goes down is the allocation of capital. A rational mind will allocate lesser capital where the risk goes up. That's why I said that only smaller portion I want to allocate to 15%, maybe to 12%, maybe to 25% I want to allocate lesser allocation. So allocation of capital, this is as per your portfolio allocation. Also in projects, you would see lesser allocation of capital when the risk goes up. When the risk goes up, naturally the return should go up. If it is not going up, then you are playing against CAPM, the capital asset pricing model, and the SML, securities market line. You remember this? That is talks about the efficient allocation of capital. This feature gives you what? Two concepts, CAPM and SML. In fact, CAPM is born out of SML. First comes the securities market line and then comes the capital allocation pricing model. ठीक है? So ये समझ गया आपने? तो ये जो swing है या जो झूला है, whatever you call this, as a lever, है ना? So इसमें risk goes down, goes up, so allocation of capital goes down, and that gives to birth to two theories here, which is CAPM and SML. Now you answer. Now, since you have understood all of this, please tell me the required rate of return. Okay, which of these you will call as required rate of return? Boliye. Let me erase all of this, and tell me which of these you will call as required rate of. So question is, which of the followings is known as required rate of return? Your time starts now. Threshold rate, ROE, IRR. हाँ, मुझे बस आप सिर्फ बताइए. And the last answer maybe if I can put, है ना, 6 है, so 7 है, so one by one, because then you are not becoming influencers to each other. Finance with the problem is everyone is an influencer. Yes, and it. Whatever your mind says, don't copy paste. Then you are not learning. In the group format, it becomes a group discussion. Your journey is very individual, and do not fear for going wrong. I mean, out of the fear that you will just whatever comes out of the heart. That means you know it or you don't know it. There are only two instances. Don't copy paste. Threshold, okay? So and it says threshold rate. Yes, I mean all of them, okay? And all of them, okay? So these are the required rate of return. Could be a threshold rate, which comes from my project team. The project management team, sir, we should make minimum this much, otherwise we will fail. Or it could be basically on some assumed rate, could also become the threshold rate, right? Now let us understand ROE. What is ROE? Return on? Okay. So why would ROE be the required rate of return? Why would the ROE be the required rate of return? बताइए. So when you are investing, correct. So when you are investing in any asset class, equity, when you are investing in the equity, say some listed company, you go back and check how much will I make if I take this risk. If I take this capital allocation, which is a risky capital allocation, how much money am I going to make? That is defined by ROE. So there are screeners which filter stocks based on ROE. People usually look for higher ROE, return on equity. But when you do that, you should also look for red flags in the ROE. That means how can you inflate ROE? What is one way you can inflate ROE? How can you inflate the ROE? So that is answered by your DuPont formula, which is profit margin, correct, multiplied by asset efficiency multiplied by capital efficiency. Yes, those formulas are named that way, but I am calling it this way. This is your asset multiplier or equity multiplier, whatever you call it. It's one and the same. I'll prove that when I'm teaching ROE. It is capital. If you bring in efficient capital, what is the meaning of efficient capital? Link it to the discussion yesterday when we were looking at one of the cases. It said we are trying to raise finance in the outside world, that means in the West, to bring arbitrage, that means cost advantage. So when you raise funds at the lowest pace, at the lowest price, then you are bringing capital efficiency. But capital efficiency does not only mean that you raise at the lowest cost. Then all government's project will succeed because you are raising from, say, from example, Japan, you are raising at just 0.5% rate of interest. The government to government lending rate from Japan to India is only 0.5% annually, and that loan is for 50 years. Can you find a better capital efficiency here? No. But then it also talks about, so it is not just about the rate of interest, it is also about the efficiency in deployment. So you will start tracking both. Have you raised at a lower cost of interest? So in the balance sheet, you will go in the balance sheet, you will go and check. In the balance sheet, you will go and check what is the cost of debt in the annual reports, okay, in the schedules, and whether there are deployments happening or not. So all your, all your deployments, wherever you are looking at the deployment of capital, CWIP, depreciation, anything which is linked to your gross block and the usage of the gross block. For example, sales over fixed assets. That also talks about the deployment. Payback periods, how project delays, they all talk about deployment. Okay? So it talks about then asset efficiency is what? This is also the turnover. So in fact, sales over assets is sales over asset is is your asset efficiency. So I'll keep the turnover, sales turnover here. Capital efficiency is about the deployment and the rate. So whichever way you can track the deployment. Is the project on time? Are they using it efficiently? They had said the first phase would be complete by December. Is it happening or not? So deployment, so also efficiency in deployment and the rate. So whenever Japanese and Koreans are doing, you know that they would complete the project one day in advance. But whenever, unfortunately, now this does not happen. This is a thing of past. Even the government projects are very fast now because there is a pressure on the capital or from the capital. If this gets delayed, then your capital efficiency goes for a toss. The asset efficiency is simply born out of how much you are producing and how fast you're producing, with the asset base, how much you're producing, and profit, how much profit margin. So it's about the operational efficiency. So if I can make it a generic word, because I don't want you to get stuck in formulas. So this is about the operational efficiency. Oops. This is about the operational efficiency. This is about the asset efficiency. And the third is about the capital efficiency. That is how you will increase the return on equity. It's a mix of three: operations at the factory level, asset efficiency at the factory level, and the capital deployment at the headquarter level. That you have to understand. Okay? So ROE is how much money you are giving to your shareholders. So I can screen whether I want to invest in this equity project. For me, it's a project or equity investments, yes or no, based on ROE. For the shareholders, and if you can look here, for the shareholders, this is return on equity, but for others, it is for the guy who has to pay this money, for the promoter, for the company, it becomes is the one and the same. For someone, it is a return. For the guy who has to pay it, in the form of a dividend or in the form of net profit, it will be known as cost of equity. You just flip the coin. For someone it is a return, so for someone it is equity. So it becomes, this is also, so I can ask either the threshold rate, which can be an assumed rate or basis my project team's requirement, their Excel sheets, their spreadsheets, or it could be the return on equity. I filter the best of the stocks, say for two-wheeler, give me 15% ROE. So if I'm investing in a startup, automotive two-wheeler, I will expect minimum 20% because matured two-wheeler companies are giving me 15% ROE. That becomes my required rate of return when it comes to investment in a startup. And I am asking for a, say, $2 million investment phase-wise. So return on equity could also become a required rate of return for that startup company. The required by the investor becomes cost of equity. This is clear. Now the third is WACC, weighted average cost of capital. That is my required rate of return. How that is? Because it is, now I will erase this part so I can write. This is clear up to this point, correct? Okay. Now let's look at WACC. Okay. Please understand, we just spoke about capital efficiency. So WACC is a concept from capital efficiency class. Okay, where you are talking about CAPM and SML. It starts with SML, goes to CAPM, comes to WACC. This is in a class of, the class should not be given such names as capital efficiency or WACC class or SML or CML. It creates a lot of confusion. Students don't understand. They think they are studying formula in finance. It is absolutely bogus concept. They are sitting in a class which should ideally be called capital allocation and efficiency. Have you understood? Yes or no? You are trying to bring capital, you're trying to bring capital, and you are trying to bring with your expertise capital efficiency. That is why Warren Buffett invests in matured businesses. When he says invest in boring businesses, he is not saying that the business is boring. He is talking about a company which has achieved capital allocation efficiency. That is why essentially they are buying in monopolies, natural monopolies. They are buying into natural monopolies. Coca-Cola is a product which does not leave aftertaste. So you don't feel that you're addicted to it. Any product which leaves an aftertaste, coffee, maybe cigarette, I don't smoke, maybe liquor, you have a feeling that you're getting addicted to it. Any food product. If you start visiting any restaurant time and again, you have this feeling, arey kuch to milata hai. They mix something into it. If it leaves an aftertaste, Coca-Cola never leaves an aftertaste. So those are natural monopolies. So when you are talking about capital allocation and efficiency, you are talking about Charlie Munger and Warren Buffett. That is what his boss, his guru, what was his name? Mr. Graham, who wrote the book The Intelligent Investor. It started from there and it reached the peak there. So capital allocation efficiency is Warren Buffett's class, and you are talking about WACC. Why are you talking about WACC? This is debt, this is your capital, this is debt and equity. Okay? So the cost of debt and cost of equity, the sum total of it becomes my required rate of return. So I should be earning anything greater than WACC. Why? Because if you're not earning anything greater than WACC, okay, so my ROE or my return on the project, okay, ROE, it could be the return to the shareholders or it could be the return on the projects. Let me just write a ROP. There is no terminology as ROP. It should be greater than the WACC. Otherwise, you are destroying capital. So you are going against your own guru. At least till this point, this is Warren Buffett or late Rakesh Jhunjhunwala Sahab or Ramdev Agrawal Sahab. They all talk about capital efficiency. So if your ROE is not greater than WACC, you are destroying. So minimum you will ask for is an ROE, provided you know the WACC. So if you are sitting in an investment, say a board meeting, if you're sitting in a startup, a pitch, if someone is pitching the idea or some company is going for SME IPO and the advisors, their merchant bankers have approached you, the first question, second or third question after the capital allocation, this is the first question. The second question in the line is what is your weighted average cost? What is the cost of debt? What is your weighted average cost of capital? Then you will see from the financial spreadsheets whether you are making more than this or not. So ROE could become, so this becomes your required rate. This is the minimum threshold rate. So a required rate, the other name is threshold rate. So any form of threshold rate, whether it is ROE, return on the project, whether it is WACC, also the cost of equity. For someone who's returning it, it becomes the cost of equity, and hence the WACC, hence the assumed rate of return. So the required rate is not a fixed concept. It is born out of individual projects, whatever be the project. It could be a road project. It could be you are heading a family office and your investment family office, and your objective here is pure investments. So you are driven by pure ROE kind of a concept. If you are investing in projects which are actual infra projects, you are driven by a threshold rate. If you are investing in maybe so this is a family office, so this is actual projects. These are project businesses versus these are investment offices. Investments. It will also depend on whether you are a majority shareholder versus a minority shareholder. If you are a minority shareholder, you are only bothered about. But if you are Warren Buffett, who likes natural monopolies, who takes possibly a seat on the board, though they don't interfere, then you would look at ROC, capital employed. Capital employed is what? This is capital employed. Debt plus equity, the whole structure. If you are a minority shareholder, you are only looking at this portion of this thing, which is the equity. If you look at this is a minority shareholders interest. If you are looking at the sum total, you are looking at someone who holds a majority position in the company, who can influence decision, who can influence whether you should invest in this project or not, who can influence who should be the CFO, CEO, whether you should open a new plant or not. That kind of investor would look at both components. A guy who cannot influence decision, who does not have a board seat, who's not a majority shareholder, essentially, or not a significant shareholder, because having a majority shareholder in all companies is not possible. If you are insignificant, you will have look at this one. Born out of this discussion, take a note. You will study about what is the definition of JV, what is the definition of associate, what is the definition of subsidiary. Okay, this we cover in our IPO classes. Read about it from Companies Act perspective, from SEBI's perspective. JV, associate and subsidiary. JV, associate and subsidiary. This is about the control. So we are talking about how much percentage you control. So one could be from the project office, that you have understood. Threshold rate is the only rate. The spreadsheet, how much, and what matters in a project is the cost of goods sold or the cost of building. That's the threshold. That's actual project. How much cement, how much labor, how much material, etc., etc. Family office, it is a pure and investment office. Maybe you're not taking greater than control of 51%. No one will love that. But here, what matters is how much I'm earning on ROE basis. Now, whether ROE is inflated or not, for that you would look into DuPont analysis. So it gets connected to another chapter. If you are looking at investments of a majority nature, then instead of looking at this one, you would look at ROC. There is another thing that you can possibly look at. ROE is okay, ROC is okay. Another thing that you can look at is, and let me remove this. Okay, you can possibly look at ROI is your IRR. So when you say this is ROI, you can say this is IRR. That is there. That is again your threshold rate. Return on investments is IRR. What is ROIC? So what is the difference between ROCE and ROIC? And given a choice, you have only one choice in the world. We have so many ratios available, that's why we get confused. आपको एक ही चॉइस, आई हैव जस्ट गिवन यू वन चॉइस, which of these would you choose and why? This is your quiz time. Please tell me which of these would you choose. एक ही चॉइस है, don't worry about being right or wrong, choose, have the courage to choose it, because we do not have the courage to choose. बताइए, ROIC versus ROC, है ना? हाँ हर्ष बोलिए, नो सर्चिंग है, टेक्सटिंग इज ओके बट यू हैव टू चूज. अच्छा, इन्वेस्टेड कैपिटल, हाँ, which one, this one? This is answer of comfort. You choose what you know. This is, you don't feel comfortable in choosing what you don't know. बोलिए, lock your answer and then we talk about it. Invested capital, this is return on capital employed. What you have invested, okay? So this is what you have invested. Say you are the promoter of the company. Now let me tweak this thing. You are not a minority. You own the company. So you are the investor in your company. No, you have only one choice, no?
If you see at ROC, automatically IC will be, because in CE IE will be there.
अच्छा ठीक है, that is ज्ञान, but tell me which one will you choose right now? Just click on the and move next. See, वो समझ गया है ना? So you are dawning, when you are explaining the difference, then you should stand here and explain. Just tell me. Yes, Harshul, which one? So let's first understand what is ROIC versus ROC. ठीक है? So ROIC, as I told you, this is what? Invested capital. है ना? ठीक है? And what is ROC? Okay. Now another question. ठीक है? Capital employed. Now another question. Can capital employed be, think from a generic sense, not from a finance term. Can this be greater than invested capital? And I'll just move out of the screen. Can it be greater than this one? So can capital employed be greater than invested capital? Yes or no? Think from a generic common sense perspective. Can it be this way? Invested capital is greater than the capital employed. Can this be true? Both are possible? Okay, this one you are not sure. So we'll check what is the meaning of capital employed and what is the meaning. So employed capital, always remember this. याद रहेगा ना? One portion, in this case, because it is a symmetrical thing, you can fold it. It's 50-50. Debt and equity, the proportion is 1:1. Okay? It is like, in this example, I can have a capital employed of this portion, 70-30, or I can have a capital employed of this structure, which is, so this portion, maybe that is, which situation Warren Buffett would be happy? Just give me one answer. You have option A, B, and C. उससे क्या ना, there will be clarity in thought and it will also get recorded. When you speak simultaneously, it will not get recorded. Which one? B. Okay. So this is how many for B? 8. See, he put you in the well and he jumped out. You go for B. How about you? Harsh is A. How about you? C. पहले तो तीनों को भिड़ा दो in the boardroom, let them fight. Whoever wins, then join. Warren Buffett would go for this. We have a very nice book somewhere here in this library, in this premises, which is called Buffettology. Just read that book. It's a very nice book called Buffettology. So this answer is correct. It is written by Maria Buffett, who's the daughter of Warren Buffett. I'm not aware how many children there were. He has one son who owns a lot of ranches and farms, and he drives the truck. So they also own a lot of farmlands and fresh water. And one of the daughters, I know how many daughters are there, I'll have to record. So also research on how many children they have. So Maria Buffett has written a book which is on the how Warren Buffett thinks, and this is the correct answer. The lower the debt, Warren Buffett is on. So same should be your case. The less you borrow, the happier you are, because if there is a COVID, if there is a lockdown, you get stuck. But someone may question you in the interview, no, what if this is a heavy capex industry? Those are industry specific. You can't avoid it. Then you have to choose the lesser of the evil. So that also is there. But rational mind, if you take a loan or go from this situation to this situation, and this go from here to here, then it shows the intent that you raised capital, more of debt, you paid off some portion, and then you paid a larger portion, right? And understand, link it to the economic cycle. So if you are here at C, if you are moving from B, if you are moving to A, you should understand the economic cycle. So if someone in the interview argues that this is important, this is what they teach in Modigliani-Millinger theory, theory, you should be aware of at this stage. Have you heard of this one? So Modigliani-Millinger theory, that no other cost assumed, which is not possible. It is a discussion born out of library or a lab, which is absolutely stupid, that there are no transaction costs, you can raise as much debt as possible till you collapse, and you will not collapse even after that. This is stupid theory. Okay? This everyone studies, and once he's out of his B school, he raises as much capital as possible. So for every 1 rupee, you can go to 2 rupees of debt, and then eventually kill the company. We have seen very good brands getting killed in the last 10 years because fresh out of the college, they thought that this is what was taught in the college, Modigliani being the theory, which says that if you raise as much as capital, there is tax efficiency, or that comes into, because it saves taxes, the interest saves tax, tax shield as they call it. It is a Bewkufi shield, it is stupidity shield, because we have seen very good Indian consumer companies die just because of this structure. And they are very good examples. They don't exist today. Some of them started a sector. They are known as the fathers of that sector. I'll give that. So, and those companies died. Okay? Look for examples in the retail space. When we stop the recording, then I'll give you those names. So look for examples in the retail space, consumer space, very good brands which we have seen since our childhood, not your childhood. Those companies do not exist. Okay? It's because of this particular theory. It is prudence which should prevail over the prevailing practice. People say, "Aisa hi ho raha hai, this is what has been happening, everyone is doing, so why should I?" So prudence goes for a toss, and then practicality takes over, that okay, everyone is doing this, is practice takes over, that everyone is doing that, but this is absolutely wrong. So look at this, so you can, and link it to the economic cycle. If economic cycle is here, you should ideally switch to here, or you should go here, hold lower amount of debt, look for cues. So when you are reading bodily anything, Millinger theory, maybe someone will say, see, I created a company on someone else's capital, I'm so happy. You should also do that. He may be right, he may have achieved success, he may have deployed capital very successfully, the efficiency part of it, but you also have to look at the economic cycle. When the economy is going on a downturn, and if you stand here, you'll be bringing a lot of stress, you'll have to fire a lot of people, you'll have to create a lot of layoffs. So be careful, operate here and link it to the, so in the Modigliani-Millinger theory, or in a capital allocation theory, in a corporate finance class, they should also be teaching economics at that point in time, macroeconomics. Otherwise, you'll get stuck. This is clear? Okay? So what we're talking about is talking about the capital allocation. Now, look at this. Okay? So someone raised, say I raised 100 crore, that's a big amount. So maybe 10 crore debt, and I raised 10 crore equity. So 20 crores I have raised. Okay? But, and there is another guy who has raised 10 crores debt, 10 crore equity. Okay? This guy has invested 10 plus 10, entire 20 is invested, listen carefully. This guy has invested, okay, he has invested only, so 10 crores of debt and, oops, 10 crores of debt, है ना, अच्छा ऐसा है क्या, debt and, ठीक है, and 10 crores of, ठीक है, this guy has, this is fully deployed, this is fully deployed at 10 crores and this is deployed at only 5 crores. Who do you think is wise? Question number 1. B is wise. Okay. This guy has invested 20 crores, raised 20 crores, 10 plus 10, deployed 20, raised 20, deployed 15. Who's smarter? In which case? Why? That is exactly the difference between ROC and ROI. So then why have you raised? Then why have you raised? Return it. Exactly. So that is the point. If someone is delayed in investing it, that is measured by, so that measures your capital deployment. Understood? Let me connect the dots here. No one teaches like this. When you talk about theory, when you talk about the capital allocation, when you talk about ROC, when you talk about Warren Buffett, it is all about two things. One is the rate of capital, which is the cost. Capital has two components. So this is the rate of capital. And you also talk about the, so this is measuring your deployment efficiency. Now, what is invested capital? In a very simple language, what is invested capital is debt plus equity minus cash. समझे आप? Is it clear? Yes or no? ठीक है. And the last point is that this also है ना, हाँ, whatever metrics you take, it is, and it is not equal, it is not equivalent. I'm saying you can choose any of these, है ना, and assumed rate, ठीक है, assume rate और project cost हो गया, IRR पकड़ लो आप, है ना, threshold rate, any of these can become a threshold rate, will be known as threshold rate, will be known as what? The required rate of return. और इसमें WACC हमने लिखा है, have you written WACC? Any of these would be required, and it is all born out of one thing which is driving is, so you have to become masters of not business administrations, master of inflation administration. This you have to have a very good handle on. समझे आप?